but very excited for this conversation today. My name is Jarrod Barnes. I am head of founder success at the Near Foundation and have the opportunity to work with all of our founders and builders who are deploying amazing products on Near. You heard earlier today from Harshit, the Infinex team, and just now from Zaki about all the innovation happening in the DeFi space on Near. And now I'm excited to actually have a conversation with the folks who are building those solutions and actually doing the work of innovation. So we have three amazing founders here today who I'm going to allow them to introduce themselves and really dig in. And of course, it wouldn't be a panel if we didn't spend time on predictions for the future. So if we have time, we'll get into that as well. But we can start here with Franco. Please feel free to introduce yourself.
All right. Thank you for having me. So my name is Franco. I'm the co-founder of Omnilane. I got my co-founder there as well, Federico. I have a background on electronics. Was also a dropout and then started my entrepreneurial path. I built REDACTED Labs, which is a software development company, about 130 people now. It's gotten quite successful, and also built other projects more on the AI side. We built an AI system for interviewing people. We built also Transcribe.me, which is one of the fastest WhatsApp applications on LATAM. It's gotten 3.5 million users, and other stuff as well during all this time. Now we're building Omnilane, which is essentially kind of unifying liquidity across chains. It's a liquidity layer that's built on top of chain signatures that hopefully will allow users to experience a seamless UX across any different chain and any different protocol.
Amazing.
Alan Hampton, co-founder of Covenant. From a background perspective, a mixed bag. PhD in artificial intelligence, then management consulting, still recovering, and have been doing a bit of AI. And before Covenant, started with a couple of friends, a fully licensed US bank.
My name is Royal Fool. I'm an engineer by background. I'm building Templar, which is a chain-abstracted modular borrowing protocol that allows you to deposit assets on any chain as collateral and borrow against them.
Amazing. So I really want to dig in on each of your use cases, but I also want to dig in a little bit to what led you to arriving to the solutions in which you're building today. And maybe, Royal, we can start with you. First, if you're comfortable, can you give us the backstory on Royal Fool as a name?
Yeah, also, it's related to Templar. The Templar Bank was the first international bank and pioneered a number of financial innovations. The traveler's check, international finance, the actual estate, and a lot of other things. So that was the inspiration that we took for the company, and going with the medieval theme. The Royal Fool is the king's jester. He's always free to speak his mind, which I enjoy doing. So that's kind of the background on the actual name there. And then the inspiration for what we're building comes from a problem that I myself faced, as well as many other people that holds crypto, and that is, namely, with the assets that you hold, if you want to do something IRL with those assets, unfortunately, there's a bit of a crypto acceptance problem, right? So if you want to, it's not just purely like an adoption problem. It's a regulatory problem. If you own Bitcoin, ETH, Near, etc., you can't just go and buy a house with that. Right, there's a bunch of regulatory headaches for that, tax implications, KYC, all this stuff that they really try and block you. So a good solution to that is that you borrow against your assets. Now this presents several benefits. One is you retain the upside potential of the asset that you're holding as collateral, and two, there are no tax implications. This is something that is widely available to banking private clients who have millions of dollars in assets. They're able to just borrow against those assets via a line of credit. Now, this is not something that's widely available to people, and crypto borrowing protocols democratize access to those services. But with each one of those solutions, they may work on a given chain, like for example, Aave, on ETH, but that requires wrapping and bridging of different assets to ETH. But we live in a multi-chain world. So being able to take any assets you have on any chain and borrow against them is a huge unlock.
Absolutely, and definitely want to keep building on that a little bit further. And maybe, Alan, to you, building somewhat of a similar solution in a different context, really tackling tradable perpetual debt. And as I was preparing for this, I had to really Google tradable perpetual debt. I'm like, what? Hold on, let's back up. So maybe for someone who isn't deeply into DeFi, first, can you explain tradable perpetual debt? And then also share a little bit more about, again, how you arrived at your solution.
Well, you had a very interesting insight when we were out there, and you were like, oh, that sounds like bonds. And I was like, well, not really, but yes. So tradable perpetual, basically what we're building is the ability to issue debt against any asset, same thing. But if you think about what's happening on chain right now, and the biggest use case is all about swapping existing tokens and basically getting margin loans against that. It's like basically, can you actually lever up your positions? And all of these positions are usually very fungible. Then the question becomes, how do you move on to credit? How do you actually then underwrite or take loans against things that are not as liquid, that are not as fungible? And there's when you start going sort of into credit. And solutions that are there right now and in the real world is like peer-to-peer. Like I give you a loan, I get whatever I have, bar of gold, and I'll give it for you for something. And you'll give it back to me. But that doesn't scale. And here's where there's a bit of an inspiration from the real world. I always believe there's like certain solutions in the real world that solve problems. In this particular case, it's liquidity, and lending has a liquidity problem on chain. And the solution is really like, let's not get all these assets to be lent out. It's really like, can we mint debt and then have that be a fungible asset itself, right? And if you look at the world from a credit perspective, it's really, there's about 200 trillion in debt. 100 trillion of that is the bond market, basically mostly treasuries, US governments issuing debt. And then another 100 trillion is really bank deposits. But that bank deposit is basically minting money, a very senior tranche of debt against loans, very non-fungible loans. And so we're pretty much building that, the ability to like issue debt that's tradable. Key difference that's only enabled on-chain, and this is a bit of an unlock, is that you don't have maturities anymore. Like if you think in the real world, everything has a maturity and then you have to roll over and whatnot. Ours are perpetual. It's an instrument that goes on forever, but the price it trades at it indicates what is the risk of that asset and hence the interest rate that asset is accruing. So it's a very big unlock in terms of like how to provide liquidity to like not as liquid assets, basically.
Yeah. And folks, you can see the theme of big unlocks in the context of DeFi here. And maybe, Franco, to go to you as well, I mean, you're taking also a larger scale approach by looking at eliminating bridging in oracles entirely. Can you tell us a little bit more about how that insight just came to you and the Omnilane team and how that's informed your approach?
Yeah. So as I mentioned, we have a background on blockchain development companies. I see a lot of clients coming up to develop new blockchains. You see Unichain launching as well. So kind of looks like the future is going to be blockchains for applications with specified use cases. Mm-hmm. So in order to build onto that future, you need a truly scalable solution that doesn't rely on infrastructure and a lot of infrastructure being deployed on each chain. So that means if you have a cross-chain swap and you need a bridge for that to work, or you need an oracle for that to work, that's a lot of infrastructure that moves really slow. So there's a lot of unattended markets right now because they don't have such infrastructure. So that's one issue. And the other issue is that nowadays a lot of cross-chain swaps or bridges, they use AMMs models. So that means that a lot of the money is used as sandbags to provide price resistance for swapping. So what we came up with is a solution that's truly scalable because it has almost 100% capital efficiency, meaning that if I have 100 USDC, it's not like each USDC is gonna be more expensive the more you trade. I can trade that amount at spot price. And then we can truly deploy on any chain because we don't rely on oracles and we don't need all those parties for our protocol to work. The key for that is, our secret sauce is cumulative state consensus, which is an algorithm that allows essentially the two parties involved on a trade to share all the information required and consent and kind of reach this consensus about the cumulative deposits of the counterparty for the trade. So yeah, that has been our approach, and that has been our vision.
Love it. And I think what's so powerful is how each one of these solutions kind of interact and compound on top of each other. And maybe, Royal, we can go back to you. You gave us, again, high-level context on what informed the origin of Templar. Can you tell us a little bit more about how you've brought this solution to life, particularly a little bit more about your go-to-market? I know you're looking at targeting chains that don't necessarily have native DeFi solutions. Yeah, can you expand on that a little bit more for folks, just on your go-to-market strategy and how you're bringing this to life?
Yeah, our go-to-market strategy is focusing on assets that don't have native DeFi, right? So Bitcoin, Doge, even Ripple, Litecoin, Cardano, these are all assets that people are holding in trillions across exchanges and wallets. And their options are they trust a centralized custodian, which happens, in which Celsius happens, right? So that's not desirable. You can alternatively wrap and bridge those assets, which not only is a high friction, poor user experience, but it just doesn't, it adds extra risk layers as well. So the go-to-market is really focusing on those assets that are unmet. They have untapped demand. And then we can also address the long tail of assets as well via our modular design. They can just permissionlessly deploy vaults for those assets as well. So it's really going after an untapped market to start, and then expanding from there, given the fact that it is omni-chain via chain signatures.
And Alan, similar question for you, but I also have to imagine, just given the nature of what you're building, price discovery for that debt matters so much. Can you also expand a little bit more on how you've brought this solution to life via go-to-market, but tell us a little bit more about price discovery and how you've just navigated probably the inherent opportunity and challenge with that as well.
I'll give two answers to that question in many ways, because the product that's live now uses sort of existing fungible tokens in many ways, like things that could be used as collateral for margin loans, and we're basically testing and having a use case for tradable debt, right? But I see the next step, and that's the path, and especially related to counter abstraction, is I see a future where there's going to be multiple chains where real-world assets are being tokenized, and there's two aspects there. One is price discovery of all of these assets, and there's a bit of a real-world connection. But the second, I think, more interesting is how do you underwrite the user, right? Like basically, a user will not have all their assets on one chain. They will have their assets in different chains that are purposely built for whatever assets being held there. And then when you start thinking about minting debt for that user from an intent point of view, that's when you start thinking like, okay, can I see the user across all chains? Connecting a little bit to AI from yesterday's talks in NEAR, like can I have agents that go through all your assets across all chains, agents that do the underwriting, and that's the price discovery, but then put it all together and then basically mint debt against all of your assets. I don't know if that answers the question.
Very much does, above and beyond. And then Franco, for you as well, given the nature of what you're building and truly, kind of flipping DeFi on its head a bit, curious if you've faced any challenges just with adoption overall, because the behavior is so ingrained, I think, in the minds of folks in using the existing DeFi primitives. Obviously, this curates a better experience, but would love to hear a little bit more about how you've navigated that in bringing truly an innovative solution to market.
Yeah, that's a good question. So we have launched on testnet so far. We're looking to launch into production at the end of this year. So far, our users have been mostly tested users, and particularly part of our go-to-market strategy at first was to reach out to potential projects that could integrate the technology in order to allow their users for kind of this seamless cross-chain application experience. I think the feedback we got so far from these initial potential integrations has been very positive. It's the simplest way to tell about it is that for the user, for example, on lending protocols, users could use their Bitcoin to be supplied on Templar or on Covenant, or they could use their USDC on Polygon, and the way that it will work is by our layer of composability that will allow for first do a cross-chain, either bridge or swap into the destination chain, and then once it arrived, you can swap for, if let's say it's a meme coin and there's no liquidity on Omnilane for that, you can simply bridge USDC, and then once it arrived, swap to the meme coin and then supply that as collateral, or you could repay debt. I see, user experience is more and more scattered. You got tokens on one chain and the other, and then maybe you have to repay $100, and you have 20 there, 15 there, and you need to do something quick. Omnilane can be kind of a clear venue for that, to simply use the tokens directly into the protocol and don't have to kind of go through that painful experience of bridging, find the bridge, waiting, and then kind of your position is more and more risky. I would say so far so good.
Which is great to hear. And I know we've spent a fair amount of time talking about solutions, and I think sometimes as a founder, the hardest thing to do is talking about solutions. So I actually want to zoom out and talk about the market a little bit. And Franco, you brought it up of just, and I think all of you are eliminating kind of pain points for users along your way. And curious if there's been a unique behavior or unique insight from the users or customers that you're engaging that has surprised you just in your process of building. Open to anyone. Yeah. Royal, I see your hand. We can start with you.
I'd like to highlight actually a pain point that a friend of mine experienced very recently. He wanted to bet on the outcome of the US election on Polymarket. Now, he's not very crypto savvy, so he knew that, okay, there's this address that I send the ETH to, right? And he sent that on Ethereum mainnet. Right, but on Polymarket, you need to do that on Polygon network, right? So then, he had to contact support, and it's not clear whether or not he's going to get his money back.
Yeah,
that's a very clear example of a problem that is solved by kind of chain abstraction and chain signatures, right? Doesn't matter what network you're working, the user shouldn't have to care about that. They should just care about what type of funds they have and what they want to do with them, not the technical details of which chain that it's on. So I think we're all making steps towards solving that.
No question, no question. And Alan, Franco, curious, any insights or observations on the behavior side, whether it's pain or actually just user behavior?
Yeah, so regarding pain, I mean, I can speak mostly for myself. Coming back again to my background, at Rattle Labs, most of our financials are in crypto, so we handle a lot of crypto, and sometimes we receive a payment on Tron, then we receive a payment on Solana, and all these different chains, and we need to move the money. So overall, per month we're like moving over $500,000, and I know from first hand kind of how painful that is. Finding what bridge has liquidity today, maybe tomorrow it won't, and kind of navigate all of that pain points that the users we assume are also receiving. Also, very excited about the intense movement. We were kind of working on our solution. We weren't kind of looking to the broader ecosystem, and we had a nice surprise when we realized that what we were doing had a name already, and that was Intense. And once we compare solutions, even with, for example, the standard that Cross and Uniswap released, we compared notes and we realized it was pretty similar. So that was a kind of nice insight that we were actually kind of into a real issue, and that others were also kind of find solutions. So yeah, that was us.
I think three learnings or observations. The first, going out and getting users, the first thing that came out is that, or struck me, is that most users right now in crypto, right, and this comes from the previous DeFi summit and whatnot, they all sort of like degen traders. They all just want to lever up, bet on something, and want to see it go up and whatnot, right? Like crazy. The second is the amount of liquidity fragmentation that exists out there. And a lot of the solutions are like, yes, you can have shared liquidity, but against, and this is like Aave, against 6 or 7 liquid tokens, but if you start going down the long tail, and this is where people get very interested, like it just becomes impossible, right?
Yeah.
And there, chain abstraction kind of helps. And then the third is lots and lots of conversations with people bringing new assets on chain, thinking about lending, and so they start thinking about credit, and hitting that wall of like lack of liquidity because of fragmentation, and because most users right now on crypto are not looking for like a 3% yield, 5% yield, or whatever is above treasury rates, right? And so it becomes a bit of a mismatch that I think slowly, and you see this across the market. I guess that's the fourth insight. Spreads are going down, right? Like everybody's like, oh, I can get 20%. And then now, as you get more and more assets on chain, everything is going down. I think the more the existing users get used to like, okay, these are the new rates, it'll become easier for new assets to then get liquidity.
Which I think, Alan, goes next to my next question, and would love for maybe you to kick it off, is when you think about long-term building in this space, how do you think about retention and ultimately actually building trust with your user, which I personally believe is one of the most compelling moats in this space is trust. So curious how that comes up for you and how you think about that. No right or wrong answers here, more just curious how you think about it, and we can go around.
I'm very conflicted because I'm in many ways, and this is just my nature, I like systems, and so I like sort of a decentralized system that works. I think the reality is, for building companies and trust and whatnot, you kind of have to be like a bit of a centralized brand. Like people have to recognize you. You have to have that front end that people trust. You can go to, will solve across chains or whatnot. And so I would say the answer there is, build a good brand that gives a solution to people and makes it really easy for people. Yeah.
Curious, Franco or Roy, if you have any other thoughts there as well.
From our position, how to build, and I relate to Alan's point of building brand. And for us, we're trying to position Omnilane as infrastructure layer. Obviously, we will have, let's say, a front end that'll be for our cross-chain swap solution, but that's just kind of the simplest use case of what Omnilane can achieve. So for us, kind of putting us into the infrastructure level, we need to provide kind of a brand of security, resilience. It won't ever fail, and things like that. So for us, it's kind of building more on the tech side, which is what I love, honestly. So focusing on the tech side, building something really scalable, secure, that is battle tested, and going into production one step at a time.
Amazing.
Yeah, I'd like to build on what both of you have said. There's two things. One component, you definitely need technical scalability and actually for it to work in the long run. All the big tech companies, they function based off of sharding, right? And that's part of what initially attracted me to Near, is I believe that in the long run, sharding is a very good way to scale blockchains, right? So obviously you need proper tech to build on that lasts in the long run. And I think that even the good actors within the space that have built products, unfortunately, most of the infrastructure that they've built on has not been scalable to date, right? So I think that's obviously been a big barrier. Another one, building on the brand, is just good behavior, right? Treat your users the way you'd want to be treated. A lot of people are in crypto because we feel like we have a moral authority to traditional finance. They don't treat people well. There are billions of people that are excluded by traditional finance, and frankly, they just serve the interests of a very select few. Our goal is to serve everyone equally, level the economic playing field. So we need to step up to the plate and act properly there. Yeah, I think the tech and behaving well are going to be the key things that we need to do. And finally, if I may add, there needs to be better acceptance from both people and governments around the world in order for this to work well quickly. Certainly, crypto is wartime tech. It's protecting you against poor behavior from governments and large corporations. But you need to be able to send those assets, and you need to be able to participate without fear of being thrown in jail or the IRS or other tax authorities coming after you for simply transacting with your own money. Not even poor behavior.
Man, maybe you should have moderated this panel. Thank you for sharing that. Incredibly powerful. We have 2 minutes here left, folks. I want to go rapid fire down the line. And Royal, you actually kind of already started it off. Number 1, biggest misconception about building in DeFi. And number 2, any advice you would have to aspiring DeFi founders. We'll go rapid fire down the line. Franco, we can start with you.
So that's a tough one. Biggest misconception of building DeFi. So I would say, at least from me, and kind of counteracting what I said earlier about focusing on the tech side, when I was coming in, and this is kind of my first kind of founder, DeFi project being as a founder, I guess I'm focusing way too much on the tech, perhaps. I should focus a little bit more on the community side. I got some people telling me that. So I would say that's my biggest issue right now. We should be kind of focusing a little bit more on the testing on the testnet, opening testnet for the community. And with that comment, I'm saying that on December 1st, we're doing kind of our open testnet for the public. We'll probably be incentivizing that as well in collaborations with some people from the NEAR Foundation. Thanks for that. I would say that's fine.
Amazing. 30 seconds each for both you, Alan, and Royal.
I think from a founder perspective, the biggest misconception or thing about DeFi is the reliance on community. Community is really, really, really huge. Anything in DeFi or crypto you want to build. The second, I think for anybody, the crypto community themselves, they don't realize that DeFi really, really relies a lot on centralized finance. There's a stronger connection than most people realize.
DeFi is not just for degens. Those are just the people that are kind of the largest users and the most loud in the space. DeFi enables the financial primitives for global free markets without interference, and that is for everyone to participate in, not just degens.
Incredible. Can we give a round of applause for the folks building the future of DeFi? All right. Thank you all for coming out to this panel.